In terms of our positioning model signals, so had a little bit of movement this week. We saw a decline in the AI bulls bears spread, and so that took a little bit of pressure off the system in terms of anticipating a near-term correction in asset markets over the short to medium term, over the 1 to 3 month time horizon. In terms of our medium to longer term signals, which start with the AI stock allocation, we continue to see a lot of red in terms of this not being a great setup, a great spot from a positioning cycle perspective to be allocating, kind of longer term capital. If you're thinking about this from a 1 year forward basis, the 3 to 4 quarters ahead, this is not exactly the spot you want to be trying to allocate a bunch of capital here. The time to do that was in, January 2023 when we pivoted bullish, or even November of 2023 when we told you to get back in, as a function of this particular model here, the positioning cycle, alongside some of the fundamental developments we saw on the productivity front with the QRA and some of the dovish Fed signaling at the time. So the positioning model can be a leading indicator for market performance, but it's not always a leading indicator for market performance. You do need a fundamental catalyst to ignite a change in the positioning cycle, which is why when we think about our positioning model, we help investors understand what is driving things like liquidity, things like the US dollar, things like the S&P and Bitcoin and gold, so we can understand, okay, what are the factors that we need to focus on that if they change, the positioning cycle will start to change. And that's something that we identified going back to the beginning of November very cleanly in terms of saying, hey, a lot of green down here in the positioning model saying this is a good spot to be allocating capital. And then we got the fundamental changes again, going back to productivity, the QRA, and the dovish Fed whispers. And so that's how you kind of layer on, that's how you combine positioning cycle dynamics with fundamental growth, inflation, policy, and liquidity dynamics to anticipate big swings in asset markets. So in terms of what could potentially change the positioning, dollar remains the dominant driver of global liquidity. The dominant driver of the U.S. dollar right now is currently long-term real interest rate differentials, and those are proxied by those are weighted on a DXY basis relative to the currencies in the DXY. And then in terms of what's driving the reverse repo facility, the high yield credit spreads continue to drive that. And then lastly, with respect to the S&P 500. The global liquidity continues to be the dominant driver there. The global liquidity continues to be the dominant driver of Bitcoin, and it remains the dominant driver of gold on a trending basis as well. So, you're thinking about what could potentially cause asset markets to reverse their performance here with some of these, red indications in the positioning model. It's, if we start to see a pullback in global liquidity, and we'll walk through how with some of the factors we see evolving over the medium term that could potentially cause a pullback in global liquidity when we get to the fundamental portion of the program.